this is fixable once you can see it clearly, because I know the second people hear no rate cuts, their brain goes, cool, so we just screwed. And listen, I get why people feel that way. I mean, we have groceries that are high, rent is high, credit cards are basically loan sharks, and then the news shows up like, yeah, relief, not yet. And then we're like, okay, awesome, thank you. That was super helpful. You're going to hear this differently after today. Your wallet doesn't care about hot takes, your real life does. If you've ever said, why is life so expensive now? Then this is for you. Don't scroll past it. So I'm going to break this down in plain English. We're going to talk about what no rate cuts actually means, why it affects your wallet even if you don't own a house, and things that you can do to stop feeling like money just isn't happening for you. So I'm going to show you and provide you with real actionable steps that you can take. And if you haven't already, hit the like and go ahead and subscribe, because we will be bringing you more topics surrounding finance. Also, this is educational only, not financial advice, just real talk so you can make informed decisions. And I'm going to be real. There will be moments where I might be frustrated, because a lot of this is frustrating as hell. But we're not going to panic. Want to get clear understanding. Go ahead and type a yes if money stress has been hitting you on your chest lately. Say yes in the comments, or say yes it has. Now here's the deal. You don't need a finance degree. All you need is translation. That's it. Because if there is anything that the economy understands, it's two languages. What officials say and what your bills say. And your bills are extremely fluent. Also, I'm going to keep this tight. We're going to stay on no rate cuts, what it means and how it hits your money, no weird detours. And I want you to leave with real actions, not just vibes. And just a quick check. What is your biggest pain point right now? You can drop that in the comments as well. Is it rent? Is it debt? Or is it buying? So now we're going to go ahead and get to the part that nobody explains on the news. Okay, so this headline right here, people read it like it's a final verdict, literally. But listen, this is not a Fed announcement. This is a market expectation and analyst forecasting. So this is where clarity beats hope every time. You don't need perfect conditions. You need a resilient plan. That's what you need. Now, take a look at this headline. This is not saying no cuts ever. It's saying markets and some analysts think rate cuts this year might not happen. That's big. And hear me on this, because that's not a policy announcement. That is a market expectation. And what do we know about markets? Markets change. And that's like your friend saying, I don't think your ex is going to text you. But that's not the same thing as your ex actually holding a press conference saying, I'm not going to text you. The market, guess what the Feds do? Markets are dramatic, and they change their minds fast, very fast. You know, kind of like we do. Markets are basically a group chat with Bloomberg terminals. That's how you gotta look at that. Now I want to show you guys something. See this here? This is Fed Watch. This chart is basically what traders are betting on. So let's get to where we are currently. The next meeting is projected January 28th, and let's do a comparison. So now, from a month ago, yikes. So what we can draw here from this chart is that right now is closer to maybe no cuts than people were expecting a month ago. So how this works, The Fed says we're watching inflation. The market says, okay, so we're not going to release them. And then everybody's wallet goes, cool, awesome, fantastic. That's how that happens. Now, this is their schedule for the meetings that their projected meetings over the course of the year. So my honest take, a lot of panic is disappointment. People planned emotionally for this relief. And when relief doesn't show up on schedule, that's when that fear moves in. Now, true indeed, we all have to adjust, right? But if you're running wild and all crazy when there is an expected change that didn't happen, then you're scrambling. This is what they're probably thinking. Oh, we have them right where we want them. Do not let them see you scramble. Do not. As a matter of fact, just stop scrambling because it's no need for it. There is no need. Now be honest. Did you expect rates to already be lower by now? Just go ahead and type yes or no in the comments for me. All of this is fixable once you can see it clearly, and I'm going to help you understand it all better today. Now, for those of you who have mortgages or about to get into a mortgage, this part is for you. Now, I will be hitting on all points surrounding the no rates problem because, again, it does affect us all. If you're a potential home buyer, this feels good on the surface, but let me break down what most people don't realize. Let me show you something. Hold on, bear with me. If I can get my screen to act properly, and I can show you what I'm talking about. All right, here we go. So did you guys see this? This is telling us where we are right now. 6.6%. This is where we are. So if we scroll on down here and look at the chart, as we can see, from the way it looks, it is definitely trending in the right direction, right? So it's down from the peak, but it's above 6%, just a little bit. And I know most people will hear that or see that and go, 6%, that isn't bad. And I'm like, okay, compared to 8%, sure. But compared to 3%, that's a whole different universe. Here's what most people don't realize. The rates aren't the whole story. They're not. The monthly payment is the story. So what this means is that it's a story. So if the price stays high, what is a lower rate going to do for you? Please, somebody tell me. It does nothing. It was never a plan to begin with. I know a couple that lives in Ohio, and they actually rented for 3 years, waiting for low rates. They finally qualified for that 6%, but their home prices are still high. And now they need a down payment that feels like a down kidney. So even with the modest drop in rates, the payment is still brutal. If the prices stay high, a lower rate doesn't save you the way people think, because price plus rate, that's the payment. The payment is what hits your life. Now, I want to give you some actionable tips really quick. If you're someone that's buying, then what you need to do first is stop rate watching like it's a sport. Run these 3 scenarios, okay? You need today's rate, the 1 point lower rate, and the 1 point higher. Now, if your plan only works in a perfect scenario, like I said, you don't have a plan. And if you're thinking of buying, then you need to compare your monthly payment changes, not just that APR. It's about cash flow, not just percentages. I hope I'm making sense so far. Who else has been waiting on rates? Now, when it comes to these rates, to me, it's like they have legs, okay? They're dang near unpredictable. let me show you something else. I hope you guys can see. Okay. Now, as you can see, this is CPI and core CPI. That's what we are going to focus on here, looking at this screen. Now, in case you don't know, CPI is basically the official inflation rate that people talk about, and the core CPI is literally the same thing. It's the same thing. The only difference is it excludes the food and energy. That's it. But they're basically the same, but the core just excludes that food and energy. So this table shows month over month inflation, which is why the numbers look so small. But it's still inflation. It's just measured over 1 month instead of a year. So you can see it quarterly, monthly. So I'm just scrolling down here so you can, if I can get my screen right. So let's go ahead and remove the part that we don't need. So now, look at these. These are the two we're looking at, CPI and core CPI. Now this again is the monthly inflation estimates. So it's showing you how the prices change from December to January. So this helps us see if inflation is trending up or down right now. When talk about inflation being above or below target, that's based on year over year CPI. And so that number tells us whether inflation is still above the Fed's 2% goal, which I'm going to show you here in just a second. But I wanted you to see the month to month to let you know you can calculate that per month. It does have the dates down here. So it's currently showing through to the 13th. But if we wanted to see the year over year, this is the year over year chart. This is what the full chart would look like, but we're just looking at those two, like I mentioned. If you look at this chart, it's showing you the inflation compared to the same time last year. Notice how the CPI and the core CPI lines are above that 2%. That means prices are still rising faster than the Fed's target, even though inflation has cooled from its peak that it was at. It still hasn't dropped below that 2% goal yet. That is the part of why markets are pricing in fewer rate cuts. So the core of it, the Fed wants inflation around 2%. Inflation is still above that. And the Fed's favorite phrase is basically, we need more confidence. Translation, yeah, it cooled a bit, but we don't trust it yet. And if they don't trust it, then they don't cut it. Kind of simplified that down for you some to where you can understand that better. All right, so I want to give it to you in a real world example. Something that's relatable to all of us, right? Groceries. We all buy that, right? So you get people that say inflation is down. But I go into the grocery store and I'm like, why does a grocery run feel like a robbery? That's what this looks like. This literally happened to me a couple of weeks ago. Went into the grocery store, didn't buy anything, but spent over $150. So, and this is because inflation coming down, it does not mean prices go back down. That's why. It just means that prices go up slower, and that difference, it makes people feel gaslit, you know. There is also stuff that is brutally hurting the budget, and it's not always the flashy stuff. I know that's what you're thinking, but it's stuff like shelter costs, insurance, healthcare services. I mean, you don't notice until you're like, why do I have less money every month, even though I'm doing the same life? I haven't changed anything. This is why these are the ones that slip through the cracks that you often do not pay enough attention to. And this is where I think the official number disconnect happens. CPI is an average. your budget is personal. Okay? So if your spending basket is rent, groceries, car, kids, then your inflation is not average, personal. Do you follow what I'm saying? Do you follow what I'm saying? It sounds familiar, right? Have you ever had a bill that just refuses to go down, like it's emotionally attached to you, or that is emotionally attached to your bank account? We talk a lot about what Fed might do. The real question is, what are you doing if they don't cut it at all? Everything I'm showing you today is how to build a plan that works with or without rate cuts. Now I'm going to show you something else. All right, graphics for economics new releases. I mean, look at it. What do you see here? It shows you all items, then it shows you food, energy, all items less food and energy. Here's the sneaky part of this. Prices, they aren't exploding like before, but you're also experiencing a situation to where they're not coming down fast. That is sticky, okay? Sticky inflation, it is annoying because it's not dramatic enough to trend. It is just quietly draining you. That's what happens. So we open up this table here. This is where we can see a list of everything by percentages, all of the categories that you can think of. Now, I have a friend that lives down in Atlanta, and he was recently expressing to me that his car repairs went up and his medical bills went up. So judging from this list, look at this, motor vehicle maintenance and repair, 5.4%, my goodness. And his medical, look at that, medical care services at 3.5, let's forbid you have to go to the hospital, 6.6, and physician services, 1.9, if you put that all together, yikes. Now, he did talk about his paycheck. His paycheck went up, but it barely went up. So savings, that's what happens to savings. They get squeezed. And when they get squeezed, you go around saying, woe is me. It's my fault. I did this. I should have saved better. I should have done that. It's always like that. If that's you, I'm here to tell you right now, you're not feeling. You're just in a tighter environment. It's death by 1,000 damn papers. So let me give you some more actionable things you can do. Do this once a month. This is your monthly money reality check. Check your essentials, your debt minimums, your subscriptions, and your ransom spending. This is not to shame yourself. This is going to help you see where your leaks are, because the sooner you catch the leaks, the better. They don't feel big until they literally drown you. All right, now stay with me because this part, it matters. Let me tell you something. The Fed looks at two things, inflation and jobs. If jobs stay strong and inflation is sticky, then they are cautious. That's the whole story. That's it. If people are still working and spending, what happens is that the Fed worries that inflation could flare back up. Cutting too early risks a rebound. The part that matters, even if you own nothing, businesses borrow money too. And when borrowing is expensive, businesses tend to hire slower after firing or laying you off. Raises can go from $1 to 10 cents. Like, what is that? Cut bonuses quietly. No more of those nice incentives that you used to get, or reduce your hours. Not much work available. So even if you don't borrow, what happened is the economy borrowed around you. I'm going to show you what that looks like. So let's say that you're someone that's making $55,000 a year. And we're not going to focus on all the bills you could possibly have right now. Let's just focus on that rent. Let's just focus on the rent. Let's say your rent went up $150 a month. Now, of course, that will make most people unhappy. Some people may think, well, it's not that bad until you break it down. Now, one of those four things just happened to you on your job. It just happened to you. You're probably thinking, what four things? Well, either you just got a raise that you were expecting to be more than what you got, your hours just got cut, you're not getting those bonus incentives, or you're laid off expecting to go back to work, but finally realizing, okay, they're not bringing you back, you're fired because they've been borrowing. Now you feel that frustration building in you, don't you? But let's say none of that happened to you on your job, that your job is intact. You don't have anything to worry about. So let's look at this calculator here. I said rent went up 150. So that's $150 per month over 12 months. Wow, $1,800 a year gone. Just like that, just gone. Let me tell you what that is. That's groceries, that's car repairs, that's breathing room, like an emergency fund. Are you serious? Now you start scratching your head. Like, dollars and cents is right. I didn't think about it like that. And guess what? We never do. This is because we are leading with our emotions. When dealing with the economy, no matter which way it swings you, you have to take your emotions out of it. You're gonna panic every single time. Did you know some people thrive off of your panic? And let me tell you, nobody at the Fed is paying your rent. So yeah, it feels personal as hell right now, doesn't it? This is why you hear people say, why do I feel broke in the economy if the economy is fine? Newsflash, because fine doesn't pay your bills. Fine does not pay your bills. So let me lead you into the next actionable tip here. If your job market feels shaky, first things first, update your runway plan. Then you need to cut those silent drains that we spoke about. The subscriptions that you know you don't need, eating out creep. If you're experiencing FOMO, which is fear of missing out because everybody else is eating out, now you feel like you need to eat out, no, go ahead and eat at home. Then there's the random Amazon. We all do that. And now this is not because you're bad, it's because you are strategic when you do this. All right, we're going to put a plan together. That's what we're going to do, so stick with me here. So now, mortgage rates, they don't move perfectly with Fed policy. They're tied to longer term yields and expectations. So even if the Fed holds steady, markets can push longer term rates around. Then there's that fear that comes in, the uncertainty, and then risk, which keeps borrowing costs at an all-time high. This is why just wait for Fed is a dangerous plan, because you're waiting on multiple forces. Let me show you the tool real quick. You see the screen here. So I'm going to show you something. What did I just do? Okay, there we go. So, for example, let's say we wanted the CPI. I think that would be it. Yep, that would be it. So let's say we wanted to look at that to the graph, and it will show us basically where it's trending, the direction that it's trending in. This was just updated January the 13th. Next release will be February the 11th. But as of right now, it has been constantly trending, even over a year's time, even though it's that split there for the CPI. I just clicked on the wrong thing. So now, let's say we wanted to see what's going on with housing. So let's click housing. And if you're wondering, okay, why are you selecting seasonally adjusted on there? Because seasonally adjusted are more closely matched, as in they're the most current. If these added to the graph, so you can always look at this to see how things are trending. You want to see it over a year. Over the year, it shows us where it's going. Let's get back to category. Okay, to prices. So let's say, I'm not gonna do all these, but let's try food and beverages now. Let's see how it's trending. This is the food away from home, food and beverages. You can literally do this by category, which is really neat, but it does show you all of the trends. So you can see where they are. You know what's so interesting is that the highest trend here is literally the food away from home. It's better that a lot more people cook at home. And then the lowest one here is the food at home. Real interesting. But yeah, again, you can come to these categories, do the same option you would like to select. You would just select the prices, go here up under the CPI to pick whichever CPI you want to take a look at. But I wanted to show you guys that before we continued. If I can give you guys another tip, like I said I would, don't make long-term money decisions based on short-term freakouts. The thing that I've been telling you about throughout this session here, you want to build a plan that survives rates higher for longer. We're going to do that now. I want to show you some things that you can do as far as building a plan. We're going to build a plan. I'm going to give you 6 different plans. Okay, we're just going to use a simple Excel spreadsheet. Now, this is going to help people move from the waiting on the Fed to I have a plan that works even if rates don't change. So this first one here, we'll just title it Pre-Rate Reality Budget Test. We got our scenario. Then we have our section for the mortgage. I'm going to say slash debt payment monthly surplus. This is what we'll title this one. All right. So I want everybody to see this because if you're like me, then you need a visual. So we're going to say current rate. Make this big enough so people can see it. So we have current rate. We're going to say one higher, one lower. Just want this big enough so it can be seen. And then we have, see, your current rate is 2,200. This would be under the mortgage, by the way. So it kind of looks weird how I did that, huh? So let me move this because it needs to be up under here. Coming in for 50. And then this one lower is 1950. I can't type over here. Okay. Okay, this is what I wanted you guys to see. Now you have a visual here. I talked about this scenario earlier on, and I said that if your life only works in a perfect rate scenario, you do not have a plan. All you have is hope, because a real plan survives the middle and the worst case scenario as well. That's what you see here. This table is literally a reality check. At today's rate, you have 300 left each month. If the rate goes up just 1 point, just one, that cushion, it almost disappears. But if the rate goes down, then you have more breathing room. The goal is to make sure your life still works in the middle and the worst case, not just the best case. Now you should immediately understand the risk since the numbers are side by side. Now I want to show you something else. So I'm going to go into a second sheet. I'm going to title it The Silent Drains. This one right here may hit emotionally because everyone will recognize themselves. Say you have Netflix and you're not tripping because the Netflix is $18 a month. That's not too bad, right? Let's say you have Spotify. And let's say the Spotify is $11 a month. And let's say, this is a good one, Amazon Prime. I do something over here. Let's say you have an Amazon Prime account, which should be $16 per month, and then let's do eating out. Let's say that bill is $220, and then let's say you have random Amazon buys. Let's say you definitely like to use your Amazon Prime when you can. And you'll just buy random things, let's say roughly around $140. And then there's that unused gym membership. Let's say it's $35. So let's go ahead and total this up. So if you look at the total, look at that, $439 a month. This is your silent drains. You know what? I thought about something. If we do take your silent drains, $439 for 12 months, yikes, $52.68. That's what you'll be looking at. That's why this one is a little bit more emotional, because you realize, wow, I'm really spending that much. That's over $5,200 per year. Now, this is how you survive higher rates. It's not by waiting for the Fed. You can even take this information, put it into a simple pie chart so you can see where your drainage is. Another one that I want to do, I'm going to title this one Emergency Runaway. Let's see. Okay, so we have 3 squares here. I'm going to keep that one blue. Let's change this one. Not the outline, but the fill. Let's go with purple. And in this one, let's go with green. Okay, so we have 3 bars here. This bar is going to represent person A. This bar is going to represent person D. And then this bar is going to represent person C. I said person X. Okay, this is going to represent person C. Person number 1, they have 1 month of savings. Person B has 3 months saving. Then person C has 6 months of savings. Some of you may already know where I'm going with this, but as I said, for a lot of us, most of us are visual people. That's how we learn. So putting it visually may help you guys out. And job loss, You have medical expenses. You have car repairs. And layoff. Right. Stick with me that I'm going somewhere with this, I promise you. Economy slows. Making this bigger for those who want to see this better, get a better visual, better experience. So as you look at all of these scenarios here, as you look at person A, they have a month of savings. Look at all what's happening around them. Job loss, medical expenses, car repairs, layoffs, economy slows, but 1 month of savings. Then if you look at person B has 3 months of savings, and person C has 6 months of savings. So I want to tell you that rates staying high, they don't hurt everyone equally. That's what this is supposed to show you. The person with runaway has choices, and the person without runaway is the one that's in fear. So this reframes money as security, not as a status, okay? So I'm gonna go into a fourth demo. This title is the weights for the Fed trap. Okay, so we're going to insert. Okay, so she is gonna be the planner. Now let's bring someone else on here, another image. Trying to really make this vivid here for you. Let's see. I'm not gonna be too picky here. I'm just gonna insert this one here. It's missing a head. Kind of find my head now. I can't believe I'm really sitting here trying to be picky over picking the shape of a head. Let's just go with this one. Let's just look at one last stage here. Let's try something. Okay, there we go. Okay, we have the planner and we have the bartender. Okay, two different people. Let me tell you what the bartender did. The bartender paused his investings, delayed his career moves, delayed buying decisions, and it's also holding cash waiting for cuts. That's what's going on with the bartender here. Look at his facial expression. Look at his posture. Look at his occupation. Which, not saying that the occupation is a problem, but he had plans on changing his career. The planner invests consistently. Not a buffer. Builds a savings buffer. Reduces debt gradually. Upskills career. And budgets. I can't spell, guys. You gotta excuse me. So now look at the planner. Look at her posture. Look at her facial expression. She looks happy, huh? You cannot be the person on the left Well, technically, the person on the right. So you cannot be the guy wishing that you were in her position because it can be done. I said that because it can be done. It can be done. So you have a visual of these two different people, things that they decided to do with their funds and the outcome. And this is what I'm telling you, what would be the same for you. So at the end of the day, the occupation part, it doesn't matter. But regardless of what your occupation is, you have to be a planner. You have to plan. Ask yourself between the two, who survives better if rate stays high for 2 or more years? That's what we gotta get you prepared for. And we're gonna go into the 5th one here. I'm gonna title this one the plan stress test. These are 5 questions you can ask yourself each and every month. Did your income drop 20%? Did your rent go up by 10%? Did your interest rate stay high 3 years ago? Did your interest rate stay high 30 years? Do you need $3,000 unexpectedly? Is your car broken down? So if you can ask yourself these questions, and if you can say no, then you're in good shape. But if you can ask yourself these questions, and if you say yes, then your plan will break under stress. Again, it's not failure. What that is just feedback. Now you get to build stronger, and this should feel empowering for you, not a scary situation. So I want to show you the last thing here. All right. So the last thing here that I want to show you, I want to show you this in a timeline format. So this is going to be called, I don't know, just going to say 2 timelines. That's what I'm going to title it. 2 timelines. You can title yours anything. So this is going to be timeline A. This is going to be timeline B. 2 separate timelines. Okay? This side, we got 2024, 2025, 2026, same year, 2024, 2025, and 2026. Look at timeline A. In 2024, you were waiting. 2025, you were still waiting. Now here it is, 2026. How are you feeling? Still adjusting life? Timeline B. You've noticed in 2024 that your budget's tightened. As soon as you notice that, guess what you did? You start saving, building up the savings because you knew you might just need it. And you realized last year, hey, I have more options. So for timeline A, anxiety increases. Guess what else happens? Financial confidence decreases. Wow, that sucks. Now timeline B, confidence does the opposite. It increases, giving you more flexibility. So the message here is that control beats prediction. If you can control it, no matter what's going on, you're good. but you have to be in control. A good financial plan, it doesn't depend on the Fed doing what you hope. It depends on you being prepared for whatever happens. So that is your plan right there that you can use to get started with. Have you reached that aha moment yet? And don't forget to like, subscribe, and share this out to someone that it can help. Just had to take that time from this segment to get into that really quick to break that on down. Let's hit the little sneaky stuff, the things people don't connect to rate cuts. Okay, we're almost done here. Now, here's what people check out because they don't think, well, what they are thinking is that I don't own a house, so this doesn't affect me. But it absolutely does. So you do have high rates, savings can actually earn something. Okay? If your savings is earning basically nothing, then you might be getting played just a little bit. Just a little. And I don't say that to be mean. I say it because banks, they are counting on you to be tired. Higher rates, less construction, fewer apartments, landlords get cocky. Everything starts spiraling all at once. And suddenly your lease renewal, it looks like a ransom note. Then there's all those loans out there, right? This is a big one, right? Auto loans. You have dealers out here that are still quoting wild payments. And then people are focused on that monthly payment, not even noticing that they signed up for a long, expensive loan. Not even noticing that. If you can't wait, what you can do is refinance later, but plan for payments now. And then we get into the student loan refinance and the retirement. Even if your rates doesn't change, high rate environments make the rest of life tighter. So payments, they feel heavier. Consider refinancing if your credit improved. And then as far as the bond yields, they do yield more now than they did in ultra low rate years. Diversification has become more interesting again. So what you can do is talk to a planner about balancing stocks versus bonds this year. And now this is what I'll say, my personal opinion. I'm not blaming anyone, but the internet, it literally sold rate cuts like a release date. And money doesn't work on release dates. Okay? Now I'm going to say this carefully. I'm not doing conspiracy. I'm just doing reality. Okay? The Fed isn't hiding secrets, but there are things the system kind of counts on people not to understand. Is that at the end of the day, it's just complicated. Like this, like I said before, inflation going down does not mean prices go down. Most people don't know that. So people keep waiting for that back to normal, and then they feel hopeless. And then another one is the rate cuts that don't instantly lower your rent or groceries. They work through borrowing and the economy over time. And then the other one is that average don't reflect your household. Remember that CPI, that isn't your exact life. And if you don't know these things, you make plans that depends on magic. And my frustration is people are out here literally beating themselves up over this. They think, why can't I get ahead? And I'm like, again, because the environment, it's just the environment is tighter and nobody taught you that translation. Okay, before we go, picture this. All right, a speculation box. I'm not saying that this is fact. I'm just saying let's imagine scenarios so you understand incentives. So we're going to look at them from different angles, 4 different angles. We're going to start here with angle 1. Let's say inflation flares back up. And let's say we get a couple bad inflation prints. Energy spikes, insurance spikes, rent spikes, hot. And in that world, the Fed says cautious longer. What does that mean to you? That means credit card interest stays nasty, auto loan stays heavy, and rent stays competitive. So just imagine a world like that. Just keep that in mind as we go into angle B. Now, angle B says, let's say we get a growth slowdown. I don't skip there to angle C, but B, let's say hiring slows more. The Fed might cut, but not because they love you, because the economy is cooling. And in that world, rates may drop, but layoffs may rise. So cuts can come with that added stress. So picture angle B. And then angle C here, let's say the market gets ahead of themselves. Let's say markets start partying and spending ramp ups. That's just like you going out partying and spending a lot of money. Same thing. The Fed might delay cuts to avoid reigniting inflation. And then we have angle D, which says, let's say you stop waiting then. Let's say you stopped, and this is my favorite. Let's say you stop waiting for the perfect moment and build a plan that works right now. And that's when you win. And I'm talking to you because I had to talk to myself first. No joke. So which scenario sounds most like your life right now? Is it scenario A, D, C, or D? Go ahead and type that in the comments and let me know. Now we're going to go ahead and land it on home. Here's the value. You don't need to predict the Fed. You just need to control what you can control. So shop savings rates. Stop donating money to your bank. Get rid of that silent drain. We talked about those, the subscriptions, the fees, the extra eating out. Buy a small buffer. Even $500 changes stress. And then if you're buying, run payment scenarios, not hope scenarios. And if debt is there, then you need to prioritize interest rate reduction strategies, and you need to also build income flexibility, like the skills, side income, negotiating. High rates, they punish people with tight margins, so we build margins over here. Now, people are out here, they're trying their hardest to put fear in people. And I'm just here to tell you, no rate cuts does not mean doom. It means patience. And you're probably like, well, I'm not patient. I can't wait for change, and I want what I want. I need this done now. Well, guess what? We're all living like that. And it's all of us, not just you. Impatience sucks, but panic is even worse. Again, you are not behind. All you're doing is navigating a harder environment. The truth may be more boring, but it's manageable. And if this made money feel less scary, then type clearer. Make sure you subscribe, of course. And if you want to follow up live how to plan, also drop a comment. And if you want to follow up live for how to plan your money if high rates last all year, then type plan. And quick reminder, this is educational only, no financial advice. It is just real talk so you can make informed decisions. Make sure you like and share.